So are things about to get a lot worse? And what do you do right now, Guy?
Well, last night we started the show, and you asked me what I thought, and I thought the market would grind higher the rest of the year, maybe some fits and starts. But, in terms of the seasonality that December brings, we'd go higher. So much for that, at least for today. But kudos to Brian, Tim, and Steve. I mean, they all talked about fading this rally for many different reasons. That proved to be correct. But in terms of the yield curve, a couple things. I thought the yield curve would flatten. I thought it would happen at 3.5%. I remember the show because Tim said that's a long ways away, 3.5%. I said, I think we'll get there, and that's where we're flattened. That actually wouldn't have been that bad a thing because it would have demonstrated maybe we're seeing the economy strengthen. We're seeing it flatten the other way with the back end of the curve going down. That's not necessarily a very good thing, something Tim's alluded to. So here we are, 2710 is a number that Steve's pointed out. I brought it up. Effectively, the market closed at 2,700 today. That's your pivot point. I'm worried that the VIX didn't trade higher than it did on a day like today. That, to me, says people are still way too complacent. So what does it mean? Maybe I was wrong last night in my assessment.
2,700 being the pivot point.
I think we're going to February lows.
25.32.
I'll make it easier. I think we're going to February lows. I don't know if they even hold. You use the Trump trade truce. That's already been shot. You're going to have 90 days, a 90-day war now of headlines. And the Fed Powell is no longer a put. It's over. I think the market is over. Yesterday when the market was up, I was negative on technicals and of the backdrop fundamentally. I'm not positive on a down day today. I'm even more negative today.
So I think in the short term, we probably got lower. But let me give you the positive to what the yield curve might be telling us.
Brian Kelly is going to be the shining light of dim day.
Yeah.
Wow.
When you look at the yield curve and you look at when recessions happen, they typically don't happen when the yield curve inverts. It's when the yield curve re-steepens. And so that period of time is usually a 12 to 24 month period. And you get actually a 25 to 35% rise in the stock market from the point that the yield curve inverts to its re-steepening. So there might be a silver lining in here.
But what else was going on? What else was going on?
We got crushed with a lot of news today.
There you go.
We've got the Trump issues. We've got a stronger dollar. Sprinkle in a little bit of problems with the Brexit. Sprinkle in a hawkish Fed potentially. And that's why I think in the short term, we've got some more lows to go. I agree, Grasso, maybe the February lows don't even hold. But in the longer run, there's going to be an opportunity here.
Well, look, I mean, the sense that growth has just disappeared overnight when, a couple months ago, we were actually talking about things getting too hot. You have to take your kind of rational, kind of middle-of-the-road look at this and say what markets are starting to price in is that there's no question that we are slowing. You can't tell me we're getting stronger, but that the growth is not falling off the cliff. The bottom line is technically the market looks to be in a very challenged place right now. I agree with these guys that think it goes lower. I think the reality is, first of all, you're at a death cross on the S&P if you want to look at some of these scary things. Yeah, you are. You basically have the 50 about ready to cross over the 200 to the downside. We've talked about that with other less important indices. But I don't think that the data is falling apart. The move in the yield curve is alarming, but I think we've seen this before.
11 years, though. 11 years. So I think it's more than just alarming, and I appreciate your calm, cool-handed approach to it.
11 years, meaning ever since the twos, fives inverted.
Right.
That was negative. The last time was 2007.
Right.
Should we discount today, though, because part of what was going on in the longer end of the yield curve was technical? Hedge funds were positioned short going into this week.
Could you always say that? Could you always say that when the yield curve inverts? There's always an excuse why it inverts. It inverts, so that's the negative part to the overall market. When you look at the backdrop to the overall market, there's nothing to be positive about from now to year end. The Fed is burning $50 billion each month. He's still raising rates even if he became dovish.
Right. So the risk to this is that, yes, the yield curve's been flattening all year. All of a sudden, everybody seems to worry about it today. My view is it's because of all these other things. The risk is something that Guy talks about every day is we're sitting here saying yield curve inverting, recession is coming, and everybody puts the brakes on. And then, therefore, the yield curve and the financial markets actually create the recession or create a slowdown because everybody gets concerned. So that is a real risk out there.
So it's like a chicken and an egg.
Well, I don't know, and again, I don't know the answer. We talked about it on your show earlier today. I think I know the answer. I do think a market sell-off causes recessions, and I think that's because, again, 73% of this economy is the consumer. To me, this is my opinion, the consumer confidence is just an overlay of the S&P 500. We can debate that as well. But if the market does well, people feel richer. If we have a sustained period of a market sell-off, and in evening news tonight at 6 o'clock leads with
Dow plunges 800 points.
People start to get concerned, and when people are concerned, they're not as quick to spend money, and then it sort of feeds on itself.
And
I don't think we're there
warned?
yet.
Who already warned? Amazon warned, Apple warned. We've had retailers already warned about a Christmas season. To the guy's point, you're a couple of weeks outside of Christmas. You're not going to see those numbers or results for a couple of months, but still you have a reason to sort of hold on to the money in your pocket and be less confident.
So are we concerned that fourth quarter results won't be as strong because consumers are going to read these headlines about all the volatility in the markets and that they're actually...
No.
But I think the market's
effect.
looking ahead 9 to 12 months, right? So the fourth quarter's already been priced in. In the short term, these warnings from Amazon and them gives you, okay, well, there's no more good news for the rest of the year. So let me just
But
throw
I
the
guess
towel
going
in
to
for the
back
rest
to
of the
Guy's
year.
thesis, I mean, if the consumer is tonight going to go home and tune into the evening news and say Dow plunges 800 points, am I going to go to Macy's and buy 5 sweaters, or am I going to go to Macy's and buy 3?
You know what? I think, Mel, you're going to buy 6 because that's how you roll. But the bottom line here is I think that I agree with Guy in terms of the wealth effect. And I think the Federal Reserve targets the wealth effect. In fact, many times throughout the course of looking at stimulus, they've been pushing on basically the stock market and also in terms of asset prices, so home prices, physical prices. But I just want to get to a place here. I just find it interesting that people are so quickly going from a place we were expecting runaway 7%, 8% growth in S&P earnings next year to a place where now it all looks like it's challenged. It comes down to valuations. The stock market should see a compressed multiple if the Fed is continuing to tighten. If the Fed is stepping back a little bit because they're worried about growth slowing down, I actually think that's going to be significantly better for the stock market than people.
But they're not stepping back, though. That's the only pushback I have is even if they're not raising, they're raising. They're lightening up on their balance sheet, $50 billion, burning it per month, $600 billion per year. That's the equivalent of raising every time they would meet.
Of tightening, yes,
Yeah.
That's for sure. Show of hands here, because I want to get the bottom line from all of you guys. Are you buying the markets off of this dip?
So let me try.
Yes,
I know you want to show
yes,
hands.
Yes, you
Please.
raise your hand.
Yes.
No, I don't think there's any reason to step in and buy it here. And I would just say that we've had a lot of great news. And yesterday, at least we were talking about, look, this market had already rallied back 6 to 10%, depending on whether you're looking at Qs or whether you're looking at S&Ps. This is not a reason, especially with the technicals, where they are to go buy.
All right, so you don't buy the broader markets, you buy individual stocks.
Well, it's interesting. So last night we had a conversation. Cirrus Logic came out and lowered
Yes.
guidance for the second time in basically a month. And we had a conversation. What does it mean for Apple? Steve said probably trades and revisits that 171 level or so. And then my question to you and to basically the audience was, has the move from 230 to 175 priced that in? That's really the calculus you have to make. But there are names that, you know, if you can take the emotion out of this, which is a very difficult thing to do, people will say, I would love to buy Amazon at X or Apple at X, and then it's there, and they pull away because they didn't think it would get there for the reasons that it did. The market never gets to your levels for the reasons you want it to. It always looks scarier than it might actually be.
So can you give us a name?
Well, I think
Scary
Apple
right now,
is
but-
interesting.
okay.
I do think that the sell-off from 230 to this 175 level is taking into consideration a lot of the things that Cirrus Logic said last night.
On your buy list.
Yeah, I think that you have to go with home builders. They've been so beaten up. And when you look at the results from Toll today, it has really cascaded through the entire space for a host of different reasons. And this is a trade that has not worked. So it has not worked thus far, but the valuations are becoming compelling. So maybe you're getting to the trough.
I think transports, they've proven that the earnings profile is very good. The valuations are very good. FedEx was downgraded by a couple folks today telling us stuff I think we already knew. We know Amazon is potentially going to encroach upon their business. Their Amazon Express and their Amazon Air are things that it's not just the final mile here. FedEx, to me, is one of the best companies in the S&Ps and certainly in the transports. The airlines also getting a benefit from weaker oil prices, and they are earning, despite Delta's warnings today, better than they have in a long time.
So I'm not buying the dip yet in equities. I mean, I tend to look at the markets more at a macro picture. To me, it looks like we got to break those February lows. It doesn't feel like we've had the capitulation. It doesn't feel like we have the VIX at the highs.
There is nothing in this market that
I would
you want
buy
to
TLT.
I knew you were going to say
See,
that.
there you go.